Welcome to everybody. And Jannis, I'm so happy to see you here. Uh, I think you're sitting in Stockholm, and you got got German background, and I'm in Copenhagen. But we do this in English, not to lose anybody. But I guess also you're working all over Europe, anyhow. But in Stockholm today.
That's right. It's super good to be here. Hi, Thomas, and hi, everybody else.
Hi, good. So I've been working with a lot of SaaS and tech companies looking for financing, but everybody that faces the dilemma when you need the financing, you're not bankable with traditional banks. And when you are bankable, then you don't need the financing. I think that's often the dilemma. So I'm really looking forward to hear how your work and your views on that, because I think that's one of the workarounds, and you are helping companies with having that focus. But before we do that, someone might be asking, who are metrics? So I'll just, not to leave anybody in the dark, I have just one slide with our background, 10, 15 seconds, and then we'll move forward to the subject of the day. So just in short, we have just launched our new automated invoicing platform. Metrics is super user-friendly and easy to implement. So we work extremely well with ERP systems, economic. All invoicing and bookkeeping is kept in ERP systems. So that's really what makes Metrics special. So we're not an external silo system. Besides that, we got quite a unique analytic platform. Please message me if you want to know any more about that. But now to the subject of the day. And just, before I'm passing over to you, Jannis, I just want to say, if anybody have any questions, just let us know in the comment section. We'll follow that and then just ask questions. And I think, Jannis, you will share your presentation afterwards. So if anybody wants a copy of the presentation, please write a comment, write that in the comment field, and then we'll forward it in the personal mailbox afterwards. But otherwise, Jannis, I think I'll just let you introduce yourself and Flow Finance, and you'll take it from there.
Wonderful. Well, thank you, Thomas, for the kind introduction. And hello, everybody. Good afternoon here from Stockholm to, I guess, Denmark and other places in Europe. It's great to be here. My name is Jannis. I'm a co-founder of Float. At Float, we offer revenue-based financing, ultimately non-dilutive growth financing for SaaS companies, but also any other digital business with recurring revenues. And we've been doing that for 4 years. We've funded more than 120 companies to date, deployed almost 100 million euros. And today I want to basically look together with you at the current market developments and how they impact financing for startups and SaaS and tech. I want to expand your toolbox with additional forms of funding and capital. You might know about some of them, you might not know about others of them. And if you already know about all of them, then I want to show you how you can actually use and deploy debt financing, revenue-based financing in different use cases to make it very tangible for you. And at the end, I have a small announcement and a little surprise, I guess, to most of you, because we're launching some new products. Let's get right into it. It's a pretty packed agenda, actually. So I don't know if you ever asked yourself, but let's say you're running a SaaS company, you're ideally even the founder. So how much of your company will you still own, and what's the value at, let's say, 10 million in ARR, and then let's say at 50 million euros ARR? Has anybody ever, done that math and kind of done that projection? So I guess we're all dreaming, all founders are dreaming of this idea to, do a $1 billion or €1 billion exit and never having to raise a single dime or cent or euro of external capital. But that's clearly the exception. The MailChimp guys did it. They were 100% bootstrapped. There are a few other examples. I think Calendly had raised $300,000. That was it. But unfortunately, that's not the rule. Much more common, it looks like something like this. So you have a pre-seed round, you give up your first percentages, a seed round. In most cases, you have actually some sort of bridge or extension round in between. And by the time you reach a Series C, you might be down, or the founders might be down to just 20, 25% in ownership. And on top of that sits usually a pretty thick stack of liquidation preferences. And if some of those rounds were done at pretty high valuations, well, then maybe the ownership is a bit higher, but in return you have even larger liquidation preferences, meaning you're basically forced to do a superb exit to ever see any money in this. So not to confront anybody with harsh realities here, but that is unfortunately how many stories unfolded after valuations came down in 2022. And if we look at the current market, I would argue that equity recently has become even scarcer, specifically for SaaS companies. Like overall, we see, of course, since 2021, a lot less funding. Depending by the count, it goes down by 40, 50, sometimes 60%, depending what segment we look at. And the money also concentrates on much fewer deals. So it's not just smaller rounds, it's also fewer rounds, first and foremost. And the share of funding that goes to AI first companies and to deep tech companies has doubled to 33% just in the past 18 months, which means classic SaaS models have a harder time to raise venture capital. Now, I don't actually think that must be negative. It might be a change, but it's negative. All of this development is also a corollary, a consequence of the fact that in many cases, B2B SaaS companies as an industry are seen as a more mature industry and more robust, more resilient, maybe less groundbreaking, but in many ways even more attractive. And this shift in market perception, we believe, it's good to react to that with a broader toolkit and toolbox of funding opportunities. Now, more recently, I'm sure you've been asked by your investors about this. There's been increasing talk of the SaaSpocalypse. Okay, I tried this word before. It's super hard. So basically, the narrative is AI will wipe out all the SaaS companies. There's a talk of the SaaS is dead, and there's talk about the software stocks are melting down. Anthropic and our other horizontal AI companies are replacing B2B SaaS companies. And as a consequence, we actually see lots of the stocks of big listed SaaS companies going down 50%. Now, importantly, we actually don't share this view. As Float, we have a fundamentally different view against this narrative. We actually believe AI is a huge efficiency booster and ultimately competitiveness booster for SaaS companies. The way we think about it is like SaaS companies, let's say 40% of the cost of a SaaS company is actually software development. Through AI, be it Cursor or Claude or whatever you want to use, or Lovable, that cost just went down by 50 to 70%. So your biggest cost item just got reduced by 50 to 70%. And that's a huge booster. And then on the product side, AI makes your product a lot better and faster. And suddenly your product can do things it could never do before. And we also believe, and this is of course part of the kind of negative narrative, that AI will substitute classic B2B SaaS apps, left, right, and center. Again, we don't believe that. And, one reason is, a SaaS business is more than just the code. The code is not the mode. The mode is the conceptualization of the product, the deep understanding of your customer workflows, the relationships you've built with your customers. And that is something that, just because coding just got cheap, nobody can replace overnight. And, then there's this other idea that your customers will build your app themselves using Lovable. For so many reasons, we don't think that will happen, at least not at scale. It's usually not worth the effort. But also many, especially enterprise companies, require ISO certifications and other types of security, SOC 2 and what have you, that a Lovable in-house built solution will never, ever deliver. We believe this is a false narrative. It's a little bit like just because everybody could potentially grow potatoes in their backyard, they will. And the truth is they don't. And the same we will see with Lovable. We think it's a false panic. But indeed, the pace has increased, and it is important for any SaaS executive, entrepreneur, founder, investor to make AI part of your internal processes and of your product offering to stay competitive. The truth is, though, that there is a real headwind in equity markets, and that's basically because if stock prices go down, there's less of an IPO market for SaaS companies. That affects late stage investors, that in turn affects growth stage investors, and that in turn affects early stage investors. So we have to deal with this as entrepreneurs. Now, if we zoom out again a bit, what I found refreshing actually to write down, and this is a truism, this is like stating the obvious, but every time you raise equity, it's a permanent change to your cap table. Permanent. It's basically impossible to reverse without exceptional levels of effort. And so all of this market upheaval and changes, the key question I think for every SaaS entrepreneur right now, what does all of this mean for us? And we believe it's important to build a very broad toolkit on the funding side, because one of my core beliefs is funding is highly situational. There is no right or wrong form of funding. There's only suitable and not so suitable funding in a certain situation. And the second one is, in these volatile times, to stay flexible, avoid being locked in for too long. It's loading. Here we go. So if we widen the toolbox, for decades, actually since the 70s, startups have been funded through venture capital, venture equity ultimately. And that's great. I mean, much of our ecosystems and the conferences we go to, the friends we have, the fellow entrepreneurs we know have been funded through VC money. It's absolutely fantastic and it's great. And then for quite a while, we had venture debt as a complement. Venture debt is basically, I would argue, it's a hybrid between equity and debt, in the sense that there is a repayable part, but there's also an upside in terms of process of getting through the fundraising. It's almost more similar to venture capital. And then you have pretty new in the market for now, the past 4 years, you have what's called revenue-based financing, or also known as venture lending. And that's straight debt without any equity kicker, without any warrants. They have short to mid-term maturities, and they can offer extremely flexible facilities depending what provider you use. Of course, there's also factoring. It's pretty heavy on the operations. There are bank loans. Most SaaS companies are not yet eligible for banking because banks want to see typically either physical assets or several years of profitability. But of course, if you can access cheap bank financing, that's recommendable. Now, I want to speak quickly, because that's what I can speak best about, how we interpret venture lending, how we interpret revenue-based financing. So what Float offers to this toolbox, and what we can contribute, is what we think is basically the most flexible credit facility for European tech companies. And I'll explain to you briefly what we mean by that, and why also we believe this is a great product, and why our customers like it. First of all, what we give you is not a one-time loan, a one-time amount of cash that sits in your bank account and costs you interest. Instead, it's a credit facility that you can draw from whenever you'd like. You can draw big or small amounts. And the beauty is that this credit facility grows with your ARR. We would typically define it as 20, 30, 40% of your ARR. Because realistically, even though you might move closer to profitability as you grow, you will probably have larger swings in your liquidity. You have larger financing needs. And so a larger credit facility is needed for larger companies. The beauty here is what we really try to do is to make it as simple and flexible and transparent for you as possible, in the sense that we do a pure pay-as-you-go pricing. That means we have only one single fee, basically the interest. We have no hidden fees like setup fees, structuring fees, exit fees, availability interest, or any charged on legal fees. So it's hyper transparent and it's highly flexible, and you only pay for the capital you actually draw down. And then each time you draw down, it's actually a term loan, but you can choose yourself how long it should be. Anything between 6 and 24 months is possible. And we offer amortization-free periods in the beginning. So that means you can basically, depending on your situation, draw a small amount now to bridge a seasonality, a larger amount in a couple of months, for example, to make a go-to-market investment, and then, stack several of these loans on top of each other, and really, let your liquidity provision and your debt funding breathe exactly with your needs. Because the truth is, nobody really knows what the future brings, especially not in these days. And so staying flexible without locking yourself in is what we are trying to give you. And this also enables you to, later take bank financing or raise an equity round or do any other form of funding, because you have this flexibility along the way. So what customers like typically is, and that's something that many might not be aware of, the cost of capital of this form of debt financing is typically significantly lower, much lower, like by a few more orders of magnitude sometimes, than equity financing. Equity, of course, is dilutive, but with the current valuations, as in contrast to the 2021 valuations, the dilution gets quite expensive. And we have on our website actually an ROI calculator where our customers or anybody really can calculate, what's the ROI of using debt. And it's typically 20 to 30 times the interest that is paid as the return on investment. And of course, debt is non-dilutive. That's the core thing. Apart from the financial benefits of that, it means you stay in control. So you don't have a board or an external investor that, directs you and takes over your strategic development. We as Float, our focus really is European SaaS businesses and other digital businesses with recurring revenues. Our philosophy is to minimize bureaucracy. And as mentioned earlier, we've financed more than 120 companies to date, almost 100 million overall deployed. And I want to give you a few ideas how our customers are using Float. So RoomPriceGenie is a Swiss company, beautiful company. They used Float basically to skip the Series A. We started financing them after their seed round, and we financed them for, 18, 20 months, more or less. They've grown like clockwork, as you can see on the left-hand side. And then eventually they did a Series B combined with a secondary. And so a growth equity round. And so basically, I don't know the numbers, and if I did, I shouldn't publish them here. But it was a very, very attractive deal for the founders, for the team, ultimately for all shareholders and also the employees, to just skip an entire letter round, the Series A, and the dilution that would come with it. Second example is Clockin from Germany. They used Float very, very programmatically. Every month they drew down a certain amount from us, which of course is a lot cheaper than, drawing a lot of money at once and paying interest on it. And then they basically financed the go-to-market, the performance marketing for each monthly cohort, because they knew exactly their return on advertising spend. They knew exactly their CAC payback period, and they could, track that and would know exactly what their return on investment was. And it paid off very, very nicely for them. Eventually, they did a Series A of 10 million euros just a couple of months ago. And again, avoided the dilution and raised that Series A at a much higher valuation because they were at a larger size than they would otherwise have. And the third example is an Austrian company. I realized none of these are Nordic. So we are from Sweden. So we have a bunch of Nordic companies and Danish companies. So this is a kind of non-intuitive use case, but we have an Austrian company, and we've done this a number of times, that just wanted to take the time pressure out of a negotiation. So Itwell had term sheets on the table for a Series A already, actually 2 or 3, but they didn't want to run out of money, and they wanted to keep investing in growth during the due diligence, just to avoid, any negativity in the process. So they just loaded the bank account using us. They kept growing. They had all the time in the world. And then they raised a very, very nice Series A. So these are some very practical use cases, how we've helped European SaaS companies and startups. I do want to say, even in these markets, I think equity in VC really has its place. I think it's really, it comes down to the nature of your business and also, very importantly, to your personal preferences. And I want to state this is super important. There's nothing wrong or right about either way of doing it. If for somebody it's highly important to become that unicorn founder, I respect that, and that's fantastic. And then to take this to unicorn quickly, VC might be the better route. But if the goal is to build a, maybe less risky business, do it more sustainably, maybe not having to hunt the unicorn status, and if you're maybe in a vertical niche with a more limited TAM, then this might be a great opportunity to use debt. I wanna skip these slides, and I wanna end with a quick note on a sneak peek what we're launching now. So up until today, Float has been only a lending business, and we have, as mentioned, funded more than 120 companies, deployed almost 100 million euros. Our philosophy has, since day one, been that we want to bring financial products that aren't available to startups to those startups. Lending is usually only for or credit has been available only to later stage companies and profitable companies and larger companies. And now we're doing the same to simplify the lives of a startup with global bank accounts and with some of the most cost competitive FX rate currency conversions in the market that you will find anywhere. And basically, when we talk about local bank accounts, we want to cut bureaucracy. We've talked to so many founders that get fed up. We get some stories that people have to fly to Dubai twice to open up the bank account for a subsidiary. We believe that in the age of deal and remote, that's no longer needed. Just like you can employ your team around the globe using deal and remote, you can have local bank accounts in any country using Float. And especially important for companies from Denmark, where much of your market might actually be in other currencies, this constant conversion back and forth from your revenue currencies, might be euros, SEK, Swiss francs, maybe US dollars, British pounds, into your home currency, DKK, costs you important margin. And 2026, we know, is also a year of margin improvement. And as such, we want to give you the best FX rates you can find in the market, starting at 25 bips, so 0.25%. This is actually being launched this month. And so if anybody's interested, I would love to hear from you. That's it. I think I stayed more or less on time. You can reach out to me by email. You can connect with me on LinkedIn. And of course, we can discuss your questions now. Thank you.
Thank you, Jannis. Interesting also with the new products coming, makes a lot of sense. One question, what typically, what do you have a focus on? I guess maybe this is a bit obvious. I think maybe I know the answer, but what are your clients typically using the money for?
Yeah, great question.
I guess it's not product development.
So product development can be a case. It's becoming less also because of AI. So the most common use case, very simple, could sometimes be just a seasonality. What we see is if you're a SaaS company with annual contracts and you have sales seasons, for example, beginning of the year, then you always know money is getting scarce around December, January, and then in February, March, the money trickles in. And so bridging a couple of months before that is a very, very short-term way of funding it. More common, and I think more value creating, is either, let's say you're fully financed, your budget is fully financed, but if you could spend more, you would have a better ROI. So why not invest a little bit more and go to market, be it salespeople, be it performance marketing? We can provide that additional funding. And something else is just, okay, you're not yet profitable, but you're getting there. It might not make sense to raise yet another round, let's say a Series B, which comes with a whole lot of expectations. Series B could mean you need to reach at least 100 million, 150 million euro in your next round as a valuation. So why not, finance that remaining 1.5 million that you might need through debt rather than equity before you turn profitable? So those are some of the situations. There are more, of course.
And how about M&A cases or buyouts and so on? Is it a tool for that sort of transactions?
Yeah, so we see that more and more. I mean, I don't know if you observed that as well, but we see that in the current market environment, more and more companies realize it's hard to raise equity, so they try to find a new home for their company rather than raising another round. We introduced 24-month maturities a couple of months ago, and since then we can actually be used for M&A as well. Previously we had 12 or 15 months. That was a bit short, but with 24 months it works, especially when it kind of happens in conjunction alongside equity.
One thing I'm wondering, what nobody hopes for, that's ending up in some kind of default where you can't pay back your loans. How are you typically handling that? Because that's always, I guess, a difficult case. Is there any difference for your cases, or how's that handled?
Yeah, I mean, I can say we do want to get paid back. So that's of course important for us. Having said that, I mean, we've had a few situations where customers couldn't pay. And I think we do the opposite of what like financial sharks are known for. So we always try to work with the company, restructure the loans, find payment plans. We might ask for additional security in return, but our goal is not necessarily to charge more interest, because we know that's not the time to do that. But instead, okay, we can give more funding or more time if we get some more security in return. That's usually how we try to do it. The more I can recommend that to anybody who gets into that situation, the more you communicate with your lender in that case, I think the more likely it is that you find an amicable solution. Cutting communication is usually the worst thing to do.
Yeah, I think one question we got here, that is, how do you pledge your cash flow, and how do you secure your loans? So what tools do you use?
Yeah, so for us, it depends on the risk assessment we do. So we underwrite each company, and we do unsecured loans. Actually, we started 100% unsecured when we started a couple of years ago. Today, it's about 50-50. It depends always on the risk assessment we do, whether we require security or not. It can also be that we say, look, the first 300,000 euros we can do unsecured. If you want to go above that, we need security. And technically, I mean, in Denmark specifically, we can take the floating charge or company mortgage. That's the most common instrument we use in Denmark. In other countries, we use the equivalent. It could be in the UK, a debenture, a fördertax in Teckning in Sweden. And in other countries, we use also pledged or assigned receivables.
And these kind of tools where, I don't know, I haven't experienced it myself, but seen that cash flow or customer payments are directed into a specific accounts, maybe your account or a lender's account, and then a part of that is it's going directly to a normal. Yeah, there's no kind of control of cash flow.
No, that's not how we work today. I see the advantages of it, and it's a very clean solution. It's also very almost risk-free for the lender. But in a way, we're sitting in the same boat with our clients, with our borrowers here. We are entrepreneurs ourselves. So I'm a founder. I was an entrepreneur at a SaaS company before, and we try to really have aligned incentives here.
Yeah. One thing people are always, and I'm curious about, that is what are typically the terms when we are here, in both interest. You mentioned a bit about the periods. What interest levels are we talking here?
Yeah, so of course it's double-digit interest, right? So depending on the risk, on the size, on the amount, and this is super important. That's why the question can be misinterpreted easily, or the answer can easily be misinterpreted. On the capital drawn down, we charge somewhere between 18 and 21%. But very importantly, that's only on the capital that's actually drawn down. So now, let's say you compare one provider that gives you 1 million euros at once, and us who give you 100,000 euros additionally whenever you need it. So, and let's say we cost 20%, the other one costs 17%. What's more expensive? 17% on 1 million or 20% on several times 100,000, right? So I don't think, to be honest, that the annualized interest rate is the most important KPI. That would be like comparing law firms by their annual rates that they charge. The way I would think about it is, what did it cost me in absolute terms, thousands of Danish kroner or thousands of euros? What did it cost me in absolute terms to solve a certain problem? And when you think about it that way, absolute amounts of money to solve a problem, we are often among the most cost competitive out there.
Thank you, Jannis. I can see that we run out of time. So I'm sure, there might be more questions, but I know that you are happy to answer any questions. Just send a note to Jannis, and if there's anything more, as you said, you're welcome to contact Jannis. So thank you, Jannis, for participating here, and thanks for everybody for participating. We'll close here. Have a nice day to you all.
Thank you, everybody. Thank you, Thomas.
Thank you.